Hi there, welcome to Funding by Alex. My name is Alex, and this is the first video of 2025, so best wishes to everybody watching. Today, I would like to talk to you about funding versus profitability. So, why is this a hot issue? First of all, you have a choice between chasing growth or chasing profitability. Growth is, in essence, deploying capital to scale your business and grab market share, grab users, grab a share of this entire market that you're putting in your pitch deck and putting towards your investors. Say, look, this is what I'm going to do. This fast growing, I'll go into that later, but this fast growing is one choice, strategic choice you need to make versus profitability. Profitability is basically chasing growing but being profitable. So in essence, you probably don't step on the pedal that extensively, and you are focusing on being profitable, so making more money than goes coming in than goes out, basically. So the issue with this is that investors usually reward growth with a higher valuation. Now, if you're a founder and you say, "Oh, I'm very interested in high valuation because my company becomes bigger, etc." So, in essence, I don't want to use the word too often, but greed comes into mind when founders are saying, "Look, I need to go into hyper growth mode because that will skyrocket my valuation." Um, and the problem with that is that there is a risk that you scale before you are ready. So I've been involved in a couple of ventures where this was not entirely clear for the founders, or the choice was simply made like, look, we took a step into the direction of hypergrowth because then it was easier to fundraise. It was easier to, you basically just, everything is easier in essence. Your valuation goes up, but in the end, your product market fit isn't there. You are scaling to basically scaling too early, scaling with negative margins also in some cases. So the entire concept behind it was not thought through to the entirety. So therefore, the company failed and or had a very bad time fixing what was not right, so to speak. So this is the choice between growth versus profitability. You again, this is a choice you need to make. You can shift it, of course, between stages of growth. I'll go into that in a moment. Before we analyze when to grow and when to go for profitability, 2023 was a turning point, basically, where late 2022 already, it was very clear that a lot of companies were betting on horses to say, look, you go grow, 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 and in the end, we'll see who is left standing. So SoftBank had a very big loss at the time in the capacity of WeWork. So WeWork is a co-working company. In essence, the company was probably far overvalued. Also with hypergrowth expansion, they were splashing money. They were splashing on making everything fancy. So the CEO of that company was very visionary. He had personality that was probably like the enthusiasm was very infectious, so to speak, and SoftBank bought into it. Now, SoftBank had a strategy at that time in general, which was if there are 10 players, we bet on all 10, or at least 8 or 9 out of 10, basically, and we hope that one of them will make it, and the other 8 or 9, that is too bad. Your collateral damage, basically. So they were always backing a lot of different players in the same field. This SoftBank implosion, WeWork implosion, made SoftBank very cautious about doing future investments like that. And in essence, in 2023 was basically the moment when everything switched from let's say we call it VC winter, basically, which is still ongoing here in 2025, early 2025. We still see that coming. So you need to present a more profitable business. So its profitability is more important than growth in most cases. So you see the number of VCs actually that are purely growth VCs is diminishing, while VCs looking more at profitable growth are increasing basically. So with that said, VC money is also moving into conventional businesses. You see, especially Indonesia, you had a very good venture capital fund that recognized it. First, they were going into food and beverage. So they went into coffee, they went into fried chicken, a couple of fast food concepts basically. So, and yeah, that is also the thing. It's more predictable. You can scale it still because it's franchisable. It still ticks all the boxes, but this hockey stick growth as in tech investment is probably it's less scalable than a tech investment basically in this case. So you see this trend also happening where VCs are looking at things beyond these get rich quick schemes basically that used to dominate the venture capital market, but yeah, the emphasis also is on growing while being profitable. So you can do both. You don't have to just burn money in order to, get the users basically, or try and prove something to whoever. So growing while being profitable is the key word here at this moment. While of course there are still examples of instances where growth is actually going to be preferred. So I'll go into that in a moment. Because you also want to know, of course, when to focus on growth and when to focus on profitability. So when to focus on growth is actually when you are playing in a large untapped market with room for rapid scaling, meaning like, you're disrupting something where there is a lot of room for growth. So meaning you need to get big fast, basically. So that is rewarding. Yeah, the growth is there. Then it still makes sense to burn money in order to become big. The same goes if you are having first mover advantage opportunity. So the first one in this scenario actually can capture the largest share of the market and have a defensible position in the market. So this first mover advantage opportunities actually is also a big reason for focusing on growth. And then last but not least, of course, this is more a common sense thing where you say, okay, if you have a large enough player who is determined enough to back it with substantial funding and has a very clear ROI strategy, so return on investment strategy, then it also makes sense to say, look, let's build this and let's do it better, let's do it cheaper, let's go faster. You have a couple of examples like that as well, where basically they took interesting concepts from large VCs, which actually maybe haven't been built in a very, what's the word? Yeah, very efficient manner. So, okay, can you do this at a quarter of the money, for example? Can you build me the same startup, but then investing less because all the mistakes have already been made by the other ones, and the market has already been. That can only be when there is, of course, enough room to grow, enough growth potential actually that is not tapped yet by the incumbents. Then substantial funding deployed by a large company. So that is normally with small startups, the fear of actually a large player waking up and say, okay, let me tap into this market as well with my own resources. Usually it's a spin-off or they back another VC. Sorry, they back another startup. So not VC back, but then more like corporate back, basically. You're looking at scenarios where focus on growth is very real in that sense. And then we go into when to prioritize profitability. So it usually applies when you have niche markets with limited scalability. So in essence, when you're playing in something where you need to manage your growth because there's not much potential there, or not enough potential, basically, to say, okay, this is the more resources I deploy, the bigger the growth. So you have a case of diminishing returns when you are investing more. It doesn't automatically lead to more market dominance because it's more of a fighting market, or basically a niche where you are catering to needs of people, basically, that it's still a niche market. So then, of course, in the case of a tough economy, so economic downturn, so when we have a recession looming, and a tighter funding climate, but that goes without saying that, of course, like now, VCs are really moving towards profitability because of, it's a tighter funding climate, the economic downturn. So the economic outlook is more difficult. So they're not splashing around money for startups to just try and experiment. They need results. They need to perform for their different stakeholders, basically. And then this is also something that you might not come across until you have, after your Series B. So when you do a Series B and beyond, the expectations from investors become different. So you have higher unit economics that you need to deliver. The expectations basically are like that from investors. Therefore, also profitability is more a key driver for these companies, for these startups, than growth. So in the end, post Series B, you're normally also already at the stage where you are looking at an exit, where there is maybe an IPO looming or something like that, where you have already established yourself in the market. So rather from startup stage to, being an established company. Thank you for watching. Basically, I hope you liked what you saw. If you did, please like and subscribe. If you want to send me an email, alex@goldendragoncapital.co. And I hope to see you in the next video. Thank you. Bye-bye.